The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto.
And then I put that into these fundamental reports for you guys. So overall, 13 fundamental tabs from different sources to gather all this information and sift through and get these perspectives for you guys on market sentiment. So what I plan to do is eventually stop having to do this, train an AI agent to do it, condense all the material, and then make sure that the AI agent is doing it for you guys every single session, which would be super awesome to do. But we'll see, when we get there. All right. So before we start on today's fundamental breakdown, let's take a look back at the beginning of this week. Can anybody give me, we're particularly fixating our attention on 3 to 4 different things that could have completely shifted market sentiment from risk on, which we left off the previous weekend because of lower inflation readings supporting rate cut bets heading into this week. What were some of the things at the beginning of the week? Just do a quick recap that we were paying attention to. Let's just talk about the primaries. Can anybody give me one?
Bank of Japan rate hike.
Okay, good job, right? We were paying attention to the Bank of Japan monetary policy decision and whether or not their rate hike was going to shake global markets and risk sentiment like it did back last summer in July, rolling into August. And I have a really good breakdown, I feel like, today in the fundamental report of why that did not happen. But good job. I think that came from DeFi Crusader. So good job. That was number one, right? We were paying attention to the Bank of Japan monetary policy announcement that we got towards the end of this week. That was one thing. What was another thing that we were fixating our attention on this week?
President Trump speaking.
Good job. President Trump's speech. Right at the beginning of the week, we talked about how President Trump was going to deliver a speech to the World Economic Forum, whether or not his speech was going to solidify any uncertainty surrounding his imposed tariffs, and just the general overall economic sentiment from the United States and whether he was going to deliver on that. Now, he did say some very positive things in his remarks. He talked about wanting to bring inflationary pressures down. He also talked about wanting to bring interest rates down, which supports risk sentiment. Keep in mind that is another reason why we saw a risk-on market mood the predominant majority of this week. He also talked about making America the global crypto superpower and pretty much called out all World Economic Forum leaders in front of everybody, which I thought was pretty badass, I'm not going to lie, even though I hate politicians and I think they're all corrupt. The fact that he publicly said that climate change is a scam and that they withdrew from the Paris Climate Accord is just badass in my opinion, because it proves that everything that we talked about in the third eye section and how these elites are pretty much trying to get us to tap into the digital agenda to track, control, and monitor us. He pretty much solidified all that, right? And not only did he do it publicly, but he did it with every single world leader listening in at the same time, which blows my now we all know, right, why they tried to kill his ass. Okay, that's just my personal opinion. So yeah, so that was cool to see, but good job, right? We were paying attention to President Trump's speech at the beginning of the week. So this week so far, we had Bank of Japan monetary policy announcement. We had President Trump's rhetoric and, speech surrounding tariffs or inflation or whatever the case may be for the United States economy. So that's 2. Give me one more before we hop off. What else were we paying attention to this week?
PMI.
Cooling labor data.
Good job, DeFi Crusader and Susan. I saw your guys' name pop up. So we were looking, generally speaking, just broadly speaking, for any data that changed the rate cut sentiment narrative. Remember last week we got lower inflation reading, we got lower CPI readings, and we got lower PPI readings, which supported the future rate cut narrative. Now, the market is not pricing in any imminent rate cuts from the Federal Reserve. The market's pricing in about a 98% chance that the Fed's going to hold rates at this policy meeting next week, which is most likely going to happen. So we're going to be paying attention to their commentary, right? Whether it comes out hawkish or dovish. But still this week, we were paying attention to any data that could change the market sentiment from last week, which supported the rate cut narrative. So we were paying attention to PMI figures, any inflationary figures. We were paying attention to unemployment claims, so on and so forth. Okay. And this week, collectively speaking, we got higher unemployment claims, which showed continued cooling in the labor market, right? So that supports rate cut bets and keeps risk on sentiment. And then we also got PMI figures and consumer sentiment coming out skewed slightly to the downside, right? So that also supported the rate cut narrative, or at least did not change the narrative that the market is gripping and holding on to, that at some point in time in 2025, the Fed is going to continue to cut rates. All right. So good job. Just doing a quick recap. That's what we were paying attention to at the beginning of the week. All right. Now, fast forward to today. Okay. So let's go over today's report. Let's just take a look at what happened via the fundamentals and why. Let's look at the total cryptocurrency market cap real quick in terms of TA.
I have a quick question. Are you doing the TA total for total 3 or total 5?
The total cryptocurrency market cap as a whole, everything. So when I look at the total cryptocurrency market cap, it takes into all crypto assets as a whole, right? But you can shift around. You can shift, like you can just look at the total Bitcoin market cap. You can just look at the top 10, so on and so forth. There's different parameters that you choose from, but I look at everything as a whole because I like to give you guys the perspective of just risk on, risk off. And so that way it doesn't really confuse anybody about certain digital assets and whatnot. It's just looking at the broader sentiment as a whole. Okay. But I just wanted to show you guys real quick.
I'm going to eat a little early before I go over.
Let me meet you
So
guys.
I have something on my belly.
So just looking again, how we can gauge that this this week was risk on, taking a, box tool or whatever type of identification tool, drawing tool you want to utilize, you can see that the weekly low came in at about $3.36 trillion, right? We significantly increased from that level all the way up to a weekly high of about 3.67 trillion. The market as of right now is holding higher low, higher high structures. And we are still trading above the weekly low. So you can assume that this week was predominantly risk on. Inversely, if it was the opposite, the market was making lower lows and lower highs, and we were breaking previous weekly lows or breaking below previous lower lows, right? And the market was trading below its weekly high or weekly low, we could assume that the market sentiment was risk off. So just looking in terms of technical analysis, and then we'll get into the fundamentals here in just 1 second. The market sentiment this week, along with last week, because last week the weekly low came in at 305 and the previous weekly high was 36. We are still trading in a risk on market environment. We'll talk about technical analysis and what to pay attention to in terms of what levels could break or hold as we head into next week, so that we know what to be paying attention to. Okay. But I just wanted to show you guys that. So January 24th, New York session market overview. Cryptocurrency market, despite the recent Bank of Japan rate hike and ongoing tariff rhetoric from President Trump, the total cryptocurrency market cap still remains in bullish structure. It continues to trade above this week and last week's lows, underscoring resilient bullish order flow, as I just showed you guys. So first, let's really dive into the Bank of Japan policy decision and the dovish tone and sentiment that we got from Governor Kazuya, hopefully I probably butcher his name, Kazuya Ueda, I'll just call him Ueda, in his latest comments and how they were interpreted as dovish. Excuse me. All right. So his comments overall indicated that the central bank remains committed to a gradual normalization of monetary policy. If inflation is inching closer to the 2% target, yet the Bank of Japan emphasized it has no preset idea about further immediate rate hikes, I'll highlight that in bold. This slow, cautious posture reduces the likelihood of a rapid yen appreciation and thus lowers the risk of the unwinding of the yen carry trade. Remember, in previous reports and in Zoom calls, we said the biggest risk to global risk assets is if the yen carry trade unwinds at a rapid pace. And if they could find some way to mitigate this risk, whether that's they take a more gradual approach or whether they implement some type of back-end system that seizes from this happening and unfolding, that's what would allow risk assets to flourish. Okay. So why the yen carry trade did not unwind, so that way you guys understand this. And I found this really dope article that kind of broke this down, but I put it into 3 parts for you guys. And I'll also read a little snippet of this article so that way you understand why it did not unwind, even though the Bank of Japan hiked rates. So number one, their gradual approach. Markets had largely already priced in a minor rate adjustment and Governor Ueda's guidance suggesting future rate moves will be measured and data dependent. This steadiness alleviated concerns of an abrupt yen rally that triggered or could have triggered a carry trade unwind. Number two, they're still far from neutral. Ueda's remarks and comments stated that the Bank of Japan is still a long way away from a neutral rate. So even if policy rates 0.5%, signals ongoing accommodative policy stances to remain intact. This further supports, by the way, I'll highlight that, accommodative policy, or them supporting accommodative policy, meaning that they need to support monetary policy or continue to stimulate or inject the economy with liquidity, expanding liquidity conditions in the economy, right? Those are dovish comments. This further supports the view that the yen will not surge aggressively, even though it did tick up slightly in strength this week. If you zoom out on the higher time frame, the yen is still relatively weak compared to other major G10 currencies. Number three, structural weakness. Like I said, the Japanese yen still remains weaker relative to other major currencies like the US dollar without a strong push towards a neutral or hawkish stance. There is a little to none catalyst to drive significant yen rallying and unwind the existing trades. So here is a tiny report of where I gathered that information from. So just to read this thoroughly for you guys. This is from Lee. Sorry guys, Lee something. I don't want to butcher his last name. Governor of the Financial Supervisory Service. So a Japanese finance minister went on to say, on January 24th, despite the Bank of Japan's interest rate hike earlier in the day, the incentive to unwind the yen carry trade is low because the US-Japan interest rate gap is widening and the yen is still weak. At its two-day meeting concluding on January 24th, the Bank of Japan raised its short-term policy rate from 0.25 to 0.5%, so half or a quarter of a point, right? A level that Japan has not seen in 17 years. Lee commented that the Bank of Japan's action during a financial situation review meeting held at the Financial Supervisory Service in Seoul, Korea, he said comparing the current financial situation to July last year, which was the summer event that I mentioned to you guys just a second ago on the 31st to the first week of August, the Bank of Japan's interest rate hike remains the same. But last year, the US-Japanese interest rate gap was narrowing and the yen was strong. He added, as the market shock occurred last year due to concerns over economic recessions following the deterioration of the US employment indicators announced right after the Bank of Japan's interest rate hike. So reading this, the way that my brain interpreted this is one of the reasons why the Bank of Japan hiking rates did not lead to the rapid unwinding of the yen carry trade is because they still see no immediate need to continue to hike rates. So most likely in March, we're going to continue to see them maintain a data-dependent approach. They did not confirm or deny that they're going to hike rates again. So it does not make the yen as appealing to investors as other assets where they're still in a more elevated interest rate environment. That's number one. Number two, the reason why, according to this fundamental piece, the yen carry trade unwound so rapidly in summer last year on July 31st into the first week of August was because there was a massive demand for the yen because investors sold their dollars due to the recessionary fears that were created on August 2nd when the NFP report came out extremely horrible, sparking recessionary fears. Remember, whenever there's recessionary fears that uptick in certain global jurisdictions, that fiat currency tends to depreciate in value as investors tend to sell that fiat currency for a safer haven play. Again, the yen being a safe haven currency on, July 31st, the Bank of Japan hiked rates that made the yen appealing. But what made it even more appealing compared to the US dollar was that the dollar data or the US data came out, sparking recessionary fears, which led investors to rapidly sell their dollars, right, and buy the yen, or rapidly sell risk assets and buy into the yen on the basis of market uncertainty, okay? So that's the way that I interpreted that portion of this report to continue reading this. As the market shock occurred last year due to the concerns over the economic recession following the deterioration of the U.S. employment indicators announced right after the Bank of Japan's interest rate hike, it's necessary to closely monitor the future changes in external conditions. The yen carry trade is a strategy of borrowing the yen at low interest rates and investing in places with relatively higher interest rates or returns. On July 31st last year, the Bank of Japan unexpectedly raised its interest rates to 0.25% per annum. Another thing that I noticed that this article said is that last year, this happened unexpectedly, so it caught the market off guard. Can anybody tell me what we noticed that's slightly different about this time? What was the market doing this week or over the past, let's just say month, pretty much the last 20 days?
Dollar strength.
It's pricing it in.
Good job. Whoever said that, I think that was Richard, right? So that was another difference. I guess what I'm trying to get you guys to see here is the difference between last rate hike and this rate hike, so that way you firmly understand why this rate hike, even though it was a rate hike, did not lead to the unwinding of the yen carry trade. What factors were different? So number one, we had the Bank of Japan. So hold on, let me regather my thoughts. Okay, so first, the uncertainty surrounding the recessionary fears in the United States did not happen this time. The United States economy is doing relatively well, making the dollar still appealing to investors. Okay, so investors are not rapidly selling their dollars and going and buying the yen like last time. Okay, also last time, the Bank of Japan unexpectedly hiked rates, which shocked the markets. Just like Richard said, this time the market had already been pricing that in. Okay, so there wasn't as big of a shock or a surprise to the markets because the markets had already been expecting that. Why were they already expecting it? Because Governor Ueda, leading up to the rate hike, started drip feeding little tiny clues to the market in his speeches leading up to the Bank of Japan hike that they were most likely going to hike rates. So the market already priced it in. So it wasn't a big shock to the market that they hiked rates because the market already expected it. So that was another thing that was different. Okay. That's why I thought that I'd incorporate this article just to kind of get you to see my brain and how it kind of formulated the idea of why it didn't create such a significant shock like it did last time. There are many different factors, including the dovish tone that Governor Ueda held after the policy decision. Okay. So hopefully, breaking that down for you guys the way that I just did, you understand the difference between the two. Even though the Bank of Japan hikes rates, it's not whether the market and how the market reacts is not just on what the central bank does. It has a lot to do with the rhetoric. It has a lot to do with the state of the economy. It has a lot to do with investor sentiment and where investors want to position themselves for the best and the safest return. Okay. So hopefully you guys see that. And again, you'll get a copy of this article so you can kind of pick through it and thoroughly read it again, so you can interpret it yourself. Next. Another reason why the market sentiment this week was risk on. So far we've covered the Bank of Japan did hike rates, but the market remained relatively risk on because the yen carry trade was still appealing, right? It says here with the yen currently weak, the Japanese interest rates still remaining relatively low, the incentive to unwind these trades was minimal. And this was emphasized by Governor Lee. Okay, so that's not coming from me. That's coming from an individual representative as a finance minister telling you guys like, hey, the yen's still appealing. The yen carry trade for investors to go and borrow Japanese yen at relatively low rates and buy riskier assets is still appealing to investors with much more money than you and I. So that's another reason why we didn't see a rapid unwinding this time compared to last time. All right. Another factor supporting risk on sentiment, the Fed, Trump policies, and the impact overall that it had on crypto. So lower U.S. rates and the Fed outlook. This week, the market still anticipates that the Federal Reserve may eventually reduce interest rates amid softer inflation data that we got last week and political pressures. Lower Treasury yields also unfolded this week, and lower Treasury yields generally make high-risk assets, including cryptocurrencies, more attractive due to the potential for better returns. Here are just some snippets of those articles where you guys can see these headlines. This is a report right here from UBS. It's this one. Let me see if I still have it pulled up. Yep, it's this one right here, where you can see they said, we also, and again, this is coming from UBS, do not think that we will halt or that they will halt the decline in inflation talking about tariffs and the upbeat U.S. economy, and that this will allow the Federal Reserve to continue to lower rates later this year. So this is coming from a large financial institution. They're still perceiving interest rate cuts to happen later this year, which continue to drive risk on sentiment as investors start to price that in. Then here's another article that says stocks rally as tariffs delayed and bond yields fall. So this is talking about the S&P 500, which again is a risky asset class, the Dow Jones, so on and so forth, the NASDAQ, hitting a 2-week high over Trump tariff jitters and threats temporarily subsiding after President Trump stopped short of imposing new tariffs on China and Europe during his first day in office. Remember, in previous reports, we talked about how that created a whole bunch of uncertainty. The market does not like uncertainty. And so the fact that those things were not imposed under President Trump is immediately when he came into office, it kind of alleviated those uncertain pressures. That makes sense. Okay. So that was one factor. Keep in mind that cryptocurrencies, they tend to be seen as a hedge against inflation and policy uncertainty. So in a low rate environment, investors tend to search for higher yield, and diversification usually tends to stem in the form of digital asset adoption now that this is a new technological advancement and investment class. So the market pricing in that interest rates are going to continue to come down as the Fed will continue to gradually cut over a prolonged period of time, as market participants like UBS and many others are continuing to price in that inflation will continue to decline. The markets are gravitating towards taking on more risk, right? As they know, in a lower interest rate environment, lending, borrowing, and so on and so forth, and liquidity injections become relatively easier and more prevalent, okay? And then number 3, we had positive regulatory news. This week, President Trump's recent move to eliminate a controversial SEC guideline, which was SAB 121, that restricted U.S. banks from holding crypto assets, also strengthened market sentiment. This regulatory shift potentially broadens institutional involvement in the crypto space. Now, institutions did not just flood in after this bill was lifted, but it still marks in my personal opinion, historical marking point in the digital asset space that will forever be remembered, because now financial institutions have pretty much the green light to some degree to custody crypto and hold it on their balance sheet. Whereas before, when this bill was enacted or in place, they could not. Okay, so that is pretty massive, right? A little bit more on the tariff uncertainty, okay? So President Trump's negotiation style prior to his inauguration, right, was threatening tariffs to obtain favorable terms. He created that volatility in the currency and equity markets, and then the initial fears of mass immediate tariffs have not materialized now that he is the president, okay? So it's kind of like investors were a little bit skeptical before, but now that President Trump is in office, they're starting to see, remember we talked about this happening, that his tariff threats might not be as serious or be as big of a threat as people in the markets have are previously thought to be, okay? So it's kind of alleviating those uncertainties and allowing investors with much more money than you and I to take on risk, because they're like, oh, it's not that serious. President Trump's going to continue to push this back. Oh, and he's trying to be friends with China, and he's kind of dialing his aggressiveness back with these tariffs. Even though it's still a risk, it's not as much of a risk as it was before he became in office, when he was like freaking everybody out about how drastically this was going to affect the markets and the overall inflationary pressures in the United States. Okay, so overall, equities and other risk assets like crypto have thus far responded positively to the absence of immediate tariff shocks. But keep in mind, looming tariff threats of 25% tariffs on imports from Canada and Mexico or China still introduce a level of uncertainty in the markets. Nevertheless, the sell the rumor, buy the fact dynamic suggests that markets may partially discount these threats until they become concrete policy. So just showing you guys a little tiny snippet of where I gathered this information. It says, it was a sell the rumor, buy the fact kind of week. Apparently, the fears of Donald Trump imposing massive tariffs on his first day in office did not materialize, and markets cheered, right? Anytime you see the terminology markets cheered, that usually tends to mean risk on, right? With previous weeks' U.S. inflation data also still providing solace or support, equity markets gained, and S&P 500 made a new all-time high and the dollar retreated. Tech stocks also got a fresh boost this week as well. And then it says here, with regards to Trump's economic policy tariffs, thus far, Trump has not announced a likely 10% increase to tariffs against China, but added that he would rather not use it. So again, remember in previous rhetoric prior to President Trump coming in office, he was like, yeah, I'm going to impose tariffs 100%. They're coming. Freaking expect them. China, you're going down, right? Whatever. I'm just giving you guys a perspective. And then now he's like, yeah, I'd rather not use them. So the market's like, phew, right? It's kind of like they're brushing it off. All the uncertainty that he was creating before he came into office, it's starting to slightly be alleviated, but still lingers in the market. So just be mindful of that. Okay. And then again, just to touch on this UBS report, I really like this UBS report and I want to read it for you guys because it talks about and touches on uncertainties that still loom in the market and gives you the same perspective that we take here at CYPRX. And it's that anytime the market experiences volatility to the downside, see it as an opportunity and not as a fear-based event. Look at it as a short-term pullback or a blip in a long-term trajectory to the upside that is going to generate you transformational wealth if you capitalize on entering into these digital assets at a discounted price if we get those opportunities moving forward. You guys know me. If you've been part of CYPRX so far, how I was able to build a 7-figure portfolio without putting 7 figures into this market is literally based off of 3 factors. If it's a risk-off market mood, if the crypto fear and index greed index, whatever you want to call it, is less than 50, and if the market is down over $100 billion, I'm dollar cost averaging into these markets. On days like today, when the market's up 30, 40, 50 billion dollars, I'm sitting back, relaxing, and just enjoying my knowledge and my awareness of why the markets are even in the green today. Okay, I'm not worried about the market. I'm not worried about missing out on positions. I'm not freaking out, dollar cost averaging in, exposing myself to more risk by buying at a top. None of that. I'm just chilling. I'm relaxing. I'm waiting for more market opportunities and understanding the risks that are to come as we head into next week. Okay. So this was really cool. I'll just read this for you guys. It says, initially, financial markets reacted positively to the absence of immediate tariffs. This is, by the way, coming from that UBS article. However, this relief was dampened by Trump's later announcement of potential 25% tariffs on all imports from Canada, Mexico, and yeah, on February 1st. Thought that said China. Creating uncertainty and volatility still in the markets. Should Trump's entire political agenda be implemented, it would have significant macroeconomic impacts. However, financial and political hurdles are likely to result in some of his announcements being implemented only partially or in a diluted form, which is positive for now. Trump's well-known negotiation tactic of escalate to de-escalate could mean that some of his proposals are more to be understood as negotiating tools rather than firm intentions. Our baseline scenario for the U.S. economy is growth despite tariffs. We believe that the anticipated tariffs will not be sufficient enough to jeopardize the U.S. growth. We also do not think that they will halt the decline in inflation, allowing the Federal Reserve to lower interest rates later this year. So I highlighted that in green because that is extremely positive. For the dollar, we see downside potential through 2025, although robust U.S. economic data and ongoing uncertainty surrounding tariffs could keep it strong in the short term. So be mindful of that. We might see, just like in 2024, right? What months were the pullback months? We saw from pretty much March, to August. If you go look at the charts pretty much pulled back or retraced, peaking at $3.7 trillion and bottoming out at about $1.8 trillion in August. Okay, we might see that again this year, where there might be a certain onset of months where we're in a pullback phase, but the overall upwards trajectory still remains intact. So be taking advantage of those opportunities if we get them. As you can see here, it says, regarding risk assets, it says equity markets, but I just say risk assets as a broad term. It says, we find their risk return profile quite attractive. However, until the effective U.S. trade policy fully crystallizes, investors should prepare for volatility or even take advantage of it. A robust U.S. economy, tailwinds from AI, gradually declining yields, and the potential for business-friendly measures also create a positive environment for equities. Again, risk assets. Furthermore, we believe that higher volatility in the currency market presents opportunities to enhance portfolio returns. And again, this is not coming from me. This is coming directly from a large financial institution. They're pretty much in a nutshell and in strategic fashion. Without telling you to buy the dip, they're telling you to buy the dip. Okay? So I thought that I'd add that in there. That was clutch. All right. So in a nutshell, okay, we had dovish rhetoric from Bank of Japan. We had slightly easing uncertainty surrounding President Trump's tariffs. And we still had fundamentals surrounding the PMI figures this week, the unemployment claims, and last week's CPI and inflationary figures, all supporting future rate cuts, keeping risk assets stronger and upbeat for now. All right. So these are the primaries. Again, there might be a whole bunch of other little tiny sprinkled fundamentals in there, like, developments in the blockchain ecosystem or from certain partnerships or whatever the case may be that might be positive for the space. But these are the primaries that these large financial institutions are paying attention to: geopolitical, macroeconomic fundamentals, policy announcements from large central banks, and economic data from certain jurisdictions. Okay, so in a nutshell, this is what's kept the total cryptocurrency market cap elevated. As of time of recording, it is up on the week, okay, from the weekly low to where we're trading at now, up about $160 billion, okay, with bullish order flow, i.e. these two previous higher lows still remaining intact. And we'll get into just a quick market projection in 1 second as we head into next week, all right? So moving on to next week, what to be paying attention to, looking ahead, what's coming out next week. Again, we'll do a little bit more of a solidified data projection in next week's fundamental breakdowns, but this is just a broad overview of what's coming out next week, because to end the month, it's going to be jam-packed. There's going to be a lot of stuff we got to pay attention to, and it's most likely going to lead to some profit taking, because at the end of a business month, when you see these types of economic projections starting to come out, investors get uncertain, and uncertainty always leads to some form of slight profit taking. Okay, that's just my projection right now. So if we continue to see a pullback into the weekend, it's most likely larger investors just starting to position themselves for next week's uncertainty. Central bank policies next week, Fed is expected to hold rates in the 4.25 to 4.5% range. Obviously, of course, anything outside of what the market is expecting is what would create massive amounts of volume and volatility. I don't think it's going to happen, but if the Fed randomly decided to hike rates, definitely most likely not to be the case. That would create a lot of market volume and volatility to the upside for the dollar. The dollar would strengthen significantly and risk assets would decline drastically if that took place. It's most likely not going to happen, but again, just remember that if data comes out outside of what the market is expecting, that's what creates those extremely volatile situations. Inversely, same thing. What would be extremely positive for risk assets and extremely daunting for the dollar would be if the Fed surprised the market with a rate cut, right? So just keep that in mind. Right now, the market is expecting that the Fed's going to just hold rates, which is probably going to be the most likely scenario, okay? Moving on, let's see what else we got. The ECB and the Bank of China both are poised next week to issue a 25 basis point rate cut, reflecting expectations of subdued inflation and softer economic conditions. So if next week, same thing, anything deviates from what the market is expecting, that's going to create those volatile situations, right? If the ECB decides to hold rates and not cut them, okay, that would obviously, of course, possibly weigh or deteriorate risk sentiment, as global central banks cutting rates is one of the key factors driving risk on sentiment. So just be mindful of that. We'll touch a little bit more on that next week. Brazil and Sweden are also set to release monetary policy, but they're not one of the major central banks we really need to be paying attention to. But still, I thought that I'd throw it in there. Any headwinds surrounding those central banks and their policy decisions next week could also implement uncertainty, fear, and doubt in global risk assets. So I thought I'd throw that in there. We also have GDP and inflation data next week. Okay, this is probably going to be another primary. The advanced estimate of the Q4 GDP is expected at 3% annualized. So anything above or below that will obviously, of course, determine market sentiment. While the PCE report also will provide further insights into inflationary trends. The ideal scenario next week that we would like to see for risk assets in a nutshell would be if we can see the Fed come out, pausing rates, but leaning more dovish, stating that they do see continued rate cuts on the table for 2025. If GDP figures can come out showing signs of cooling in the U.S. economy but without sparking a recessionary fears, and if the PCE data can come out showing signs of cooling inflationary figures, that would be the best risk asset, risk on environment, because it would support future rate cuts and deliver more market optimism under Fed policy positioning. Okay. Eurozone GDP next week as well. We have in the Asia zone, we have Australia's Q4 CPI and Chinese PMI figures as well. Again, not anything too significant to be paying attention to. You guys know we really pay attention to the primaries, Tokyo, London, and New York, right? But I still thought that I'd throw that in there. We also have earnings reports next week. That will be important for risk assets. Obviously, of course, earnings reports that come out relatively upbeat, showing that these, companies are pulling in profits, they're healthy, they're freaking giving good dividends to their investors and everything's solid on that end. That's going to boost risk sentiment. If anything shows signs of deterioration and stability of these economies, or that their earnings reports came out weaker or lower than the market is expecting, that could deteriorate some of the risk sentiment, and it could create a market pullback as stocks would most likely decline. That would also deteriorate overall market sentiment and affect crypto assets as well. So I thought that I'd throw that in there. We do have corporate earnings next week to be mindful of. So just to wrap this up, okay? Governor Ueda's cautious stance points to measured approaches in raising rates, which has kept the yen carry trade intact for now. Remember, the yen carry trade is when investors with much more money than you and I have been borrowing the yen to go and buy into riskier assets like stocks and crypto, okay? What we do not want to see is an unwinding of that, a rapid strengthening of the Japanese yen, and investors rapidly selling risk assets like stocks, crypto, or their dollars to buy the yen at a very rapid and strong pace. Okay. Crypto strength. The sector continues to benefit from lower rate expectations, improved regulatory clarity, and the perceived hedge it offers against both inflation and political uncertainty. The President Trump's escalate to de-escalate approach also has kept the markets relatively volatile. Any substantial shift in tariff policies may quickly alter risk sentiment, so just be mindful of that. Because remember, President Trump, I believe after his inauguration, said that he plans on, implementing all this stuff on February 1st. As we inch closer to that date, if the markets become uncertain, we're probably going to start to see some profit taking. After that February 1st date, we see some more clarity surrounding his imposed tariffs. If it does not affect market sentiment or uncertainty as previously expected, then we'll probably see a risk on market mood continue. Inversely, if he does impose those tariffs and it starts to create trade war shocks and shit starts to spiral out of control and investors are like, screw this shit's crazy, it's super uncertain, it's going to continue to deteriorate market sentiment. So just be mindful of that as we head into the first week of February. And then, like I mentioned, upcoming drivers. We got central bank rate decisions next week, macroeconomic data. Don't forget the unemployment claims next week from the United States will also be important. Ideally, like I said, what we need to see is cooling data from the US, cooling inflationary figures, and dovish comments from the Federal Reserve next week, along with continued rate cuts from other major central banks. And then couple that with any type of certainty or commentary from President Trump solidifying that his imposed tariffs are not going to negatively affect trade wars or inflation. That would be the best ideal scenario for risk assets next week. If we can get that, we will continue to hold bullish momentum. I will continue to be optimistic above $3 trillion and not tell you guys that it's looking like we're going to head down into 2.2 to 2.5 trillion. We're going to continue to the upside. Inversely, if next week we see any fear, uncertainty, and doubt surrounding President Trump's tariffs, right? We see any elevation in inflationary readings or any economic data that comes out extremely upbeat, resilient, or above market expectations, pushing back on rate cuts, or we see any hawkish rhetoric from Fed speakers or any other central bank speakers pushing back on the future prospects of rate cuts taking place continuously in 2025, those are going to be the things that deteriorate market sentiment and start to create more of a profit-taking, risk-off scenario next week. All right. So in a nutshell, simply just wrapping up how we started off this week, what happened this week, and then what to be paying attention to moving forward into the week ahead. I hope that this video breakdown today cleared the air on some of those uncertainties and things surrounding the fundamental data this week. I do appreciate you guys for tapping in with me today. I think for the fundamental side of things, that's really all I have. I don't actually want to get too much into the technical analysis. Just long story short, what I'm really paying attention to right now, more short term, is that the sentiment next week continues and that we can maintain bullish order flow above last week's previous higher low at roughly about $3.8 to $3.6 trillion, or that we can hold above this week's higher low at 3.36 trillion, right? If we can do that, looking at the higher time frame, as long as we can maintain, because again, we just most recently broke above this previous high, which was from, I'm trying to think of what fundamental came out on January 6th. Shit, I don't remember. I think it had something to do with Russia, Ukraine, or some, yeah, I think it was a Russia-Ukraine event that took place, and all this sell pressure started to unfold in the markets, right? We have just recently created another bullish leg up, okay? So that means ideally what we would like to see is one of two scenarios to continue in terms of structure, higher price action. Either a deep retracement down into the previous weekly low to accumulate orders and then continue and flip risk on, or a slight retracement down into this week's previous low and a continued risk on sentiment, right? As long as fundamentals support a risk on environment, these are the two scenarios that I'm personally expecting. However, if the market sentiment deteriorates, keep in mind that on some technical analysis platforms like CoinGecko and CoinMarketCap, for some odd reason, it showed that we actually did poke above the December 2024 high at $3.7 trillion. So worst case scenario, the market sentiment deteriorates. This turns into a liquidity grab. We start to break beneath the previous weekly low. I will start to be a little bit concerned. I will be extremely concerned if we see a higher time frame close beneath the December or January low, coupled with a risk off market environment. Because again, we have not since August of last year seen a monthly close beneath a previous monthly low. So if you go on the higher time frame, i.e. the weekly, let's get rid of all the drawings. Actually, it might be more clear on the daily chart. Right? And we go all the way back to August. This is where the Bank of Japan hiked rates on July 31st. We had the major sell-off, the bad economic data from the US sparked recessionary fears, and then boom. First week of August, market bottomed out. Rolling into September, higher low, higher high formation. Rolling into October, higher low, higher high formation, right? Rolling into November, higher high, higher low formation, then boom, November, President Trump trade came into fruition, everybody pricing in future rate cuts from the Fed. Okay. Markets rolled into December, right? So again, from September to November, higher low. Then December, on the 8th of December, remember we had geopolitical uncertainty in the Middle East. That was the first sell pressure that we got the beginning of December. Then the second to mid-December week, we had Jerome Powell come out with a more hawkish tone, dialing back the market expectation of 4 interest rate cuts from the Fed down to 2. And he did that on December 18th. That's where we had this major sell-off. However, this December low still maintained the bullish order flow month after month intact, where you can see from November to December, we continued the higher low, higher high bullish order flow. And now in January, even though the market dipped beneath the December low, on the daily time frame and above, we have still not seen a daily candlestick close beneath a previous monthly low, right? So overall, the market is still holding pretty much ever since August till now. The order flow has still been to the upside. So that's why I continuously tell you guys, as long as we can hold on the higher time frame above a previous monthly low, the uptrend is most likely going to continue, whether it looks like this, whether it looks like this, or whether it looks like this. As long as the order flow can continue, this trajectory will most likely continue along with the sentiment. If that changes at any moment in time, meaning the sentiment gets worse, risk appetite deteriorates, and couple that with a structural break for the first time since August of last year, a previous monthly low, I can almost guarantee it. We are most likely going to correct this overly extended bullish move. So prepare for that. That means that if we do end up closing beneath 3 trillion to 2.9 trillion dollars on the higher time frame under worsening market conditions, you can expect a pullback down into this previous monthly low. It just only makes logical sense, because if the market makers stop targeting highs and bullish order flow along with sentiment ceases to exist, they're going to want to hunt liquidity beneath previous higher lows where buy leverage positions exist in the market. And that will require them to push prices beneath previous higher lows, which exist all in these areas. Okay. So just be prepared for that if it does happen. If we see a break beneath these previous higher lows under worsening market conditions, worst case scenario is I'm expecting us to completely retrace the November move and to touch back into 2.2 to 2.5 trillion dollars before settling out and determining whether the market is going to recover, or worst case scenario, who knows, maybe even break lower, but we'll see if we get to that point. Okay. For now, the uptrend on the higher time frame remains intact above the December and January lows at 3.2 to 3 trillion dollars. All right. Well, that's what I'm paying attention to right now for the total cryptocurrency market cap. I think outside of that, that's all I got for you guys. Any questions, commentary, just open talk, chat? You guys want to have a conversation real fast? I have about 5 or 10 more minutes to give to you guys, and then we'll hop off for the weekend.